Good afternoon, everybody. Welcome to another in our series of webinars over Bright Talk. And I'm Robert Dixon and look after UK distribution for Han ETF. And today I'm delighted to be joined by one of our partners, Anthony Ginsberg. And Anthony is the founder and CIO of Gins Global, which is an index and ETF asset manager based in California. So Anthony was the second partner we had at Han ETF and is a renowned tech evangelist and also a very keen tennis player. And is it true that you actually played tennis with Elon Musk, Anthony?
Yeah, he has a bit of a temper on him, but yes.
Oh, right. Okay.
Yeah.
Well, I mean, maybe you can give us a few thoughts on the valuation of Tesla and the most recent quarterly reports and prospects later, Anthony. But anyway, Anthony partnered with us at Han ETF in 2018 and launched three tech-themed ETF, which are or were very relevant pre-CV19, but are certainly most relevant now and looking into the future. So these give global exposure to cloud computing, healthcare innovation, that's everything outside of big pharma, and also a super equally weighted tech megatrend solution, which has 8 of the sort of most relevant themes in one solution. So that crosses cloud, cyber, social media, robotics, AI, genomics, future cars, digital entertainment, and even blockchain. So, but I'll maybe talk about, we can touch on that a bit later, perhaps. But generally, I mean, thematic ETFs are attracting significant investor attention wherever we look, and from investors of all types, just because they're easy to use and using a multitude of different ways in portfolios. And last year, we in particular, we saw some startling performances, and I think the best performing ETF in the US was I think a solar play, and it was up something like 263%. But anyway, we all know that the GICS classification changes in late 2018 sort of forced people to look at tech in a different way, and it's complicated things. So thematic solutions via ETFs just make it such a granular and understandable way of getting targeted and also diverse exposure to the themes in a sensible way. So I'm not surprised that the AUM growth in the US in 2020 was pretty enormous. I think up something like 40% in thematic AUM growth between sort of Q3 and Q2 in particular. Anyway, Anthony will sort of take us through some of his observations and thoughts of some of the most interesting areas in the Great Tech Conference, and in particular some of the US themes of relevance that might affect the tech space or give opportunity, but also things like the legislation, Biden, and antitrust issues for very big tech and what that means to some of the indices which are a little bit leaning towards such names. And then we'll have a Q&A session post Anthony's slides. There aren't that many of those, I believe, but and please, as we go through and as Anthony's talking, if you could just drop questions you may have into the forum, and I can pick up on those and we can address them post Anthony's delivery. And without further ado, Anthony, I'll sort of hand over the reins to you, if you don't mind.
Many thanks, Rob. It's great to join everybody this afternoon. I look forward to making it as interactive as possible. So we'll really follow a Q&A format. I just have a couple of quick slides, just given the recent earnings just this week from obviously the likes of Apple, Tesla, and Microsoft. I mean, all three of them really shot the ball out of the park and had tremendous earnings. So the digital revolution, as we all know, is one of the leading beneficiaries, frankly, of the pandemic and the lockdown, particularly cloud. But to start off with, I wanted to just focus on our tech megatrend fund. Actually, that's up. It's been up 60% over 2020. Year to date, it was up almost 8% as well. And let me just try and bring the slides up. If we can just start there, Rob, let's just see if we can get the slides up for everybody. And what we're going to show you is actually how last year electric vehicles were amongst the leaders in the digital revolution. So I'm just going to go to the very first slide so you can all see. These two slides actually show the short term and the long term for electric vehicle usage. You can actually see in red how China over the next 2 to 3 years is way and above the mainstay and leader in the electric vehicle area. So we all know about NIO, which is sort of their Tesla over there, and they're well ahead of the US. Now, I think with Biden coming in, he's going to subsidize electric vehicles, and he's actually on a very, very big climate change agenda. So most likely he's going to provide discounts and subsidies for various EV vehicles as well as hybrids here. There are also rules that we're expecting to pass that by 2035, gasoline or petrol powered cars will no longer be able to be sold in the US. We already have that rule here in California. It's most likely going to be rolled out across the US. So just if you look at the blue line there on the left, the US is barely at sort of a 2% market share for electric vehicles. Currently, it's expected by 2023 to grow to about 4%, whereas China is a multiple of 3 to 4 times that. And if you go to the right-hand side, you'll see over the longer term, if you look at 2030, the global market share of electric vehicles will be around 30%. So by 2030, it's an easy number to sort of remember. We expect EV to have a market share of 30%. So there's going to be a huge ramp up. We know Tesla themselves expect their production numbers to grow by 50% just this coming year, 2021. They sold 500,000 cars last year, which was a record for them. But their aim is to actually be doing 1 million cars essentially by the end of next year. And ultimately, their goal is to be producing close on 15 to 20 million by 2030. So China will still be the leader for the next decade and a half. But it's interesting if you look at Europe. Europe is also ahead of the US, but given the focus of the Democrats coming into office now under the Biden administration, there's a huge push to basically subsidize EV vehicles. So I'll move on, but I want to just mention that last year was the best year for electric vehicles globally in terms of the numbers produced. It was essentially almost double the 2018 figure. Now, many of us during lockdown know that our kids have been, and younger folks have been buried on social media. And I just wanted to show you the advertising impact there. Essentially, advertising is increasingly moving away from traditional means to online. At the moment, close to half of all advertising spend in the US is essentially online. It's predicted to jump to about dominate 2/3 of all advertising spend. Again, those numbers are almost double where we were back in 2015. So there's been a massive jump. Just to give you a sense of the change per year, per annum, 2018, you saw a 34% gain in advertising via social networks. Last year doesn't look as impressive. It was double digits, so there was close to 12%. This year is predicted to be about 21%. And if you just look at the numbers, you can see it's gone from 28 billion marketing spend to 56 billion, basically double in 4 years. So there's been a massive growth in advertising spending, and that's really powered a lot of the social media companies, the likes of Facebook and Twitter. But we can dive into that a bit further. I just wanted to give you a brief overview. The other big theme last year, besides future cars and social media, which we hold in our tech megatrend ETF, is genomics and digital health and gene editing. And particularly if you look at what's happening in the telehealth segment, it's predicted to basically be growing at a compound rate of close to 30% over the next 5 years. So when we look at digital health overall, you'll see at the very top of the slide, the compound annual growth rate is predicted to be close to 30%. Telehealth, if you go further down, is looking at around 26% annualized. I mean, these are massive growth numbers projected for the next 5 to 6 years. And I think what might surprise many people is how Asia is actually amongst the fastest adapters. It's not that surprising to us because Asia actually is a leader in both areas such as cloud and digital entertainment as well. So it's not surprising that they would also be the fastest adapters to digital health. Just to bring the US into this for a moment, until very recently, telemedicine wasn't federally insured So most of the healthcare insurers had not given the green light. But in the last 6 months, there's been a sea change here. And that's really powering telehealth. We actually think these numbers may be underscoring the adoption rate in telehealth, particularly in the US. And now that all the insurers have adopted telemedicine in this country, you'll also see Biden administration spending a fortune on upgrading healthcare systems. As many of you know, America doesn't have an NHS or a nationalized healthcare system. So somebody who gets ill in California, but maybe from another state like New York, never the twain shall meet. It's quite difficult to actually harmonize all the records and the databases. And that's also why you see big tech moving into healthcare in a big way in this country. We have the likes of Amazon buying the biggest pill dispenser or pharmacy group online in this country recently. And even Google, for instance, now owns a part of the hardware segment. They've also bought a healthcare tracker like Fitbit for a couple of billion. They spent $2 billion on really essentially a loss-making entity, Fitbit. And of course, Apple Watch can also help with blood sugar levels and other fitness trackers information. So we actually see big tech moving directly into the space. Tim Cook, the CEO of Apple, has frequently said that he feels his legacy won't be the iPhone, but it will be actually Apple moving increasingly into this healthcare space where the profit margins are quite appealing to them. Rob, I'll just go through a few other quick ones. When you look at cloud and what's going on there, many of us know that Amazon's web services dominate the infrastructure side. They have about a third of the market share, and this is worldwide, globally, followed by Microsoft at just over half of that, at about 18 to 20%. It's worth saying that just earlier this week, Microsoft had blowout earnings on cloud. Actually, their Azure, which you see up there at 18%, the second largest, actually grew revenues by 50% year over year from the prior year's quarter. So it's a tremendous growth. I mean, and they actually are going to be shrinking that deficit with Amazon. So we expect Amazon's numbers to come below 30% and Azure to actually exceed 20%. Google's quite far behind, and Alibaba is in fourth place. The prediction by experts is that Alibaba will become the third largest cloud infrastructure player. And just something to note there is, for the first time, cloud infrastructure revenue, which includes the platform as a service and infrastructure as a service, it exceeded 100 billion. And that number is predicted to also double within 4 years. So Rob, I just have one or two more. This is about digital entertainment that my kids and many others have been also spending way too much of their time on. What's not easily understood is that a lot of the online gaming and digital entertainment is coming through mobile. So this slide is broader than just online gaming. This particular slide obviously relates to online streaming with videos such as Netflix, here in the US, HBO Max and Disney Plus. And what surprises many is that mobile, particularly on the gaming side, is actually dominating. It's about half of all the online gaming revenue. So 160 billion is the online revenue, online gaming, excuse me, for overall for digital entertainment, of which mobile is essentially half. And that's partly because cloud is driving digital entertainment. Cloud really underpins a lot of the fourth industrial revolution. Even Tesla is using cloud to actually upgrade their cars remotely. And the famous case quickly with cloud and being remote means that the consoles, if you look at the bottom right there, you'll see consoles are actually only about a third now. This is gaming consoles for the likes of Xbox and Nintendo, etc., and the Wii, from Sony. Consoles actually have been superseded by mobile gamers, and really that's all downloaded via the cloud. And just to bring this into relevance today, many of you have heard about GameStop and the craziness in the last couple of days. GameStop, my kids told me, Dad, it's a bit of a dinosaur because they're selling physical discs. So the truth is that most people don't believe GameStop has a huge future. But this is just very interesting. If you look at the digital side, mobile really dominates. And another way to look at online gaming, the size really is significantly larger than Hollywood. So the global size of online gaming at around 150 billion is actually almost 4 times the box office of Hollywood. It's a massive, massive area, and it's often underreported. Last year, we saw the growth rate in double digits, and it's predicted to essentially continue around 10% a year in online gaming growth. Interestingly enough, with Spotify, recorded music is significantly smaller at about 20 billion, and box office there shows 43 billion. Rob, this is my final slide. I just wanted to give an indication of how tech megatrend actually tackles the digital revolution. And what we've tried to do is equally weight the 8 key themes that we see representing the fourth industrial revolution. And if you go back every year to 2015, you'll see there are different winners and losers. Back in 2015, 2016, robotics was one of the winners. Cybersecurity has been a winner as well in 2018. This past year, actually, by the end of the year, future cars had actually been the winner, along with cars and batteries. But iTech, because we're equally weighted over the recent 5-year period, we've actually had a very, very significant performance by, instead of just putting all our eggs in one basket. So the whole idea of tech megatrend is really as a broad foundation to play this overall fourth industrial revolution. And then, of course, we have clients who want to drill down further into healthcare through our ETF there on innovation in healthcare as well as cloud. And with that, I'll turn it back to you, Rob. If I could just say one word about the Biden administration, because a lot of questions seem to be coming up about that. There are 3 key things about Biden. The one is, of course, climate change and pushing clean energy and clean electric vehicles. The other thing to say is that he's not going to change dramatically on China. And we do see a splintering of the internet because there's a bipartisan support here for cracking down on both cybersecurity and espionage issues that many view coming out of China, as well as the 5G aspect of the likes of Huawei. But I will say we're not going to expect individual companies to be banned the way Trump did. I don't think we're going to wake up on Sunday mornings and hear about a particular company being targeted. Biden really wants to work with the international community, with the EU, in a much more process-driven method. He's probably going to go after Section 230 also, which is a big issue in the US. It allows the likes of Facebook and social media companies to be immunized and indemnified, frankly, from putting all kinds of nefarious things and comments on their websites. And there has been blowback here about people being, people's accounts being closed by Twitter and the like. And even if one doesn't agree with certain Republicans and Trump himself, the fact that these guys have been banned recently seems to indicate that they have too much power. We expect privacy rules from Europe also, this GDPR rule, which provides online consumers more protection. That passed in California, a very similar EU type rule about a year ago. It hasn't been rolled out federally yet under Trump, but we expect that to be one of the first online legislative efforts in Congress to roll out a nationwide privacy rule, which will probably grandfather the California rule. With that, Rob, perhaps I'll turn it back to you, and I'll just end the slides.
Okay, thanks, Anthony. There's some great slides there, so we'll probably revert to them in a few minutes. It's probably worth just I've had a couple of questions in actually, Anthony, already, so I will answer one of them, or we can together. But there is one here that someone was just asking, what's beyond the fourth industrial revolution? What do you foresee there? And maybe what's the next biggest mega trend? Is it quantum computing or something? What anything to bring to the party there?
Well, it's a good question. Actually, we are already seeing into the future a little bit. It's called edge computing and quantum computing, which will be powered by the likes of cloud. So sorry to harp on it, but basically without cloud, we wouldn't be able to get not just to the future, but we wouldn't be able to scale up. many of these companies, whether it's the Twitters or the Netflixes, or frankly Airbnb of the world. Another one would be Uber. They're all massive users of cloud computing. If you actually look at who the top 10 clients are of the likes of Amazon Web Services or Microsoft's Azure, it's many of these same names. They basically are required to outsource a lot of their server power globally. And what edge computing talks about is a multiple cloud where you get large Fortune 500 entities, multinationals, basically sharing their data across multiple clouds. Up until about 3-4 years ago, they had to make a bet really on one cloud provider, and it limited the sharing of data for some of these multinationals, particularly with different subsidiaries and entities globally. What's happened now is with open source software, you find the likes of IBM made their largest acquisition in their history. Actually, they bought a multi-cloud platform called Red Hat, which basically has this open source Linux software. And the point really is that you can actually no longer have to bet on a single player. And that's why we see edge computing, along with 5G, by the way, will also help. But ultimately, the Internet of Things is the future. It's going to power a lot, but you do need a very robust cloud. Up until recently, the developing world had quite a big gap in terms of infrastructure that it was lagging in. We've now seen parts of Africa actually catch up. Asia is actually in the lead in terms of their infrastructure and their bandwidth speed. So that's where we see the future. Basically, the infrastructure build out, Rob, in the last 5 years has been tremendous. So
Yes.
all the pipes have been laid.
And Anthony, in that regard, I mean, a couple of years back, obviously when we were first having discussion, Anthony, the US players obviously were and still are very, very significant cloud players. A bit of the landscape shifted, as you said, with the IBM Red Hat acquisition, for example. But when I would talk to friends that were board company directors and whatever in Europe at utilities and quite often talk about cloud, they really were behind in terms of their adoption and utilizing the best of that cloud can offer. But obviously they've had a catalyst to change that. Are the US corporates looking at growth outside the US particularly, obviously in the rest of the developed world, and do you think that they're sort of locked out a bit because of the US China friction and Trump, to sort of working more closely together? How do you see that landscape playing out?
Yeah, it's a very good question. Look, there's no doubt that there's a lot of friction on the 5G point, but I will say that the one disappointment actually in cloud has been that SAP, the big European holding that most folks would have, and we actually own a small piece of SAP in our cloud holdings. Actually, our cloud index is expanding up to 75 holdings and will be equally weighted very, very soon, similar to how our tech megatrend looks. What we've actually found is that SAP have struggled to actually keep pace, Rob, and that's probably part of what you're mentioning. The tricky thing really is that the big FANGs and even the big cloud players in the US, up until 3-4 years ago, they were really just focusing primarily on the States and hadn't really worried too much about the developing world. It's changed a lot. There's a lot more corporate spend going on globally. We actually see the revenues of the FANGs themselves, as an example, being almost 50% non-US, just to give you a sense. And that's driven the cloud infrastructure to follow them. So the likes of the Netflixes, Googles, Apples, and even some of the smaller players like Airbnb, Uber, because they've gone global in such a fast way, and Netflix too, it's actually propelled Amazon Web Services, Azure, to really follow, a little bit like the banks following big exporters in the old days with the UK. So if you just sort of think about HSBC going off and Barclays going off globally to all the colonies, I mean, this is a little bit like the Americans following their big guys into the larger developing world. So Asia led the play as well as Europe, and you're now seeing parts of Africa and Eastern Europe, etc., coming along in the last 2 to 3 years. And I just mention one thing that confuses folks, which is that the FANGs themselves represent close to about 40% of the Nasdaq, and the Nasdaq is quite a risky concentrated index. We've been quite careful to downplay the FANGs. So we only have essentially a 1% holding in each of those. Let's call it about a 5-6% holding in our tech megatrend ETF. Unlike the Nasdaq, which at this point, 50% of the Nasdaq is actually comprised of 7 major players. And if you look at the price to book and the price to sales and even the P ratios there, they tend to be a lot more expensive than what we've been able to thematically construct for the digital revolution. So we feel we're drilling down, Rob, more into some of the mid caps and the broader tech segment, rather than just being sort of massively overweight 5, 6, 7 stocks.
And also, Anthony, and the reason that, well, anecdotally, why clients are embracing iTech in their portfolios is because it's global, and just taking money away from the sort of over reliance on big US tech names, as we've said.
Yes.
In Nasdaq and quite whatever. But allied to that, we've got a question on the GICS, sector classification we alluded to earlier. But is it no longer fit for purpose given the growing number of sector themes available to invest in? What's your view as a ETF creator, solution creator?
Yes. Well, I like that question because it's actually very relevant. Yes, it's almost 2 years ago. The global classification system went through a crazy rigmarole with the technology and landed up throwing Facebook out, for example, out of tech, and put it in a new index called the communications index, which sort of grew up out of nowhere. And overnight, you've got the likes of Facebook and a few other social media folks. Basically, they dumped 30% of the market cap out of the tech traditional sector index and put it into communications, also consumer staples. Got the likes of Disney, Disney Plus, and this new communications index still confuses many folks because are you buying a communications sort of infrastructure, 5G player, or an AT&T type of phone company, or are you actually getting Twitter? So it probably isn't fit for purpose. And you actually, if you bought a traditional old tech sector ETF, for instance, boy, you're really losing out on probably close to 40% now of the old line traditional tech companies. I'll just mention something else, Rob, you talked on.
Please.
57% of our mega trend is now the US. That's expected to come down to about right on the button 50%. If we had been talking 3.5, 4 years ago, that number probably would have been closer to 70%. So the US weighting in the digital revolution, you're right, is coming down all the time. Actually, at the moment, Asia is close to a 30% weighting. So although you have this splintering with China, there's no doubt it cannot be ignored. So we, of course, own Tencent and Baidu and Alibaba and some of the big players in Asia, but some others too in Southeast Asia as well. So at the moment, we have over 100 holdings actually in that megatrend ETF. And interestingly, the healthcare innovation side of things is also not, people might think it's 80% US. It's actually well below that. It's in the 60% range. Again, Asia Pacific and European holdings make up the balance.
No, that's fantastic.
Global trend.
No, I think it's probably important to just have a quick run through sort of just the mechanics of indices for those that don't know, because we have got a question here about, can you as the manager, Anthony, change the weightings between the sectors with an aim to improve returns? So obviously I'd just like to just put my sort of 10 pennies worth in, and then maybe you can have just about generic ETFs and thematic ETFs and indices. But the whole thing about an index is that they're or an ETF is that they're tracking index, and the transparency is there. An index should be in its best form, rules based, so everyone knows what they're doing. But particularly in the ETF world, where market makers, to make effective prices during the intraday trading periods on the stock exchanges, they need to be able to hedge, and to do that, they need that transparency through the index, and they need to know what the rules are, etc. as well. And so managers in the sort of passive or thematic ETF world, are constrained by the index rules, And obviously, there's a lot of thought and research that goes into the creation of the indices. And I'm sure you'll know that, Anthony, from working with Han in the early days in this regard. A lot of oversight, and there are investment committees. But so we don't really change weightings to improve returns. However, important in a index design is a rebalance period. And depending on the type of style of theme and what you're trying to capture, if it's an emergent nascent theme, you may want to capture new entrants into that theme on a sort of regular basis. So you'll notice that, for example, which is not one of yours, Anthony, but in our cannabis, our medicinal cannabis and wellness UCITS ETF, that the index has a quarterly rebalancing, so that new companies can get sucked into the index if they meet the right liquidity and market cap criteria, on a quarterly basis, because it's just a brand new industry. So you want to capture these companies, but in a efficient and transparent and rules-based way. So for your three solutions, iTech, for example, that we're talking about, the equally weighted index has a semi-annual rebalance, and so does the Sky cloud computing UCITS ETF, but the healthcare innovation one has an annual rebalance, if I'm correct. So but maybe you just want to put just answer that in just a few words as well.
No, it's a fair point. I think we've really gone for the more diversified approach generally. So as I mentioned earlier on, the tech megatrend, which is iTech, has basically 104 holdings at this point. Interestingly enough, although it's equally weighted, blockchain, which is the broader online play, it's not cryptocurrency, although it provides some of the infrastructure for the likes of Bitcoin and others. But we've gone for the broader play. So blockchain only has a couple of holdings right now. We expect that to be built out. So we have 15 holdings basically in our mandate per sub-theme. So blockchain is slightly underrepresented because, again, talking about rules-based, we have a rule that you have to have a company has to be listed. It has to have $100 million of minimum market cap. It has to be able to be traded at least generally $1 million, perhaps up to $2 million minimum a day for average daily volume. So these are some of the rules that we can't change. And in the case of blockchain, obviously, it's been a little slow in coming along, but we're happy to say some of our best performers last year. In fact, of all the themes we're talking about, blockchain actually was the best performer last year. I was just looking at my notes. I mean, it's crazy, but it went up into about 250% last year, blockchain. We have two particular companies. One's called Riot Blockchain, which provides a lot of server data, actually, that's used by cryptos and others. But again, it's not a cryptocurrency. We've stayed away from the cryptocurrencies themselves. We're basically buying the infrastructure players there, the behind-the-scenes players who help the data miners, the people who might mine the Bitcoins. They're using certain IT services. Those are the blockchain guys. It's basically online ledgers. I'm a boring accountant by training, so it makes sense.
Nothing wrong with that.
Yeah, I guess I'll speak for myself, but the point really is that blockchain was actually the best performing sub-theme. Just quickly, if you look at the other sub-themes, I was looking at the numbers, future cars and gene editing last year, both did around 72%, interestingly enough. And digital entertainment beat those, because digital entertainment on its own did about 105% last year. So it's very hard to pick and choose. And we don't want to re-weight anything. We basically realize we're going to probably be underweight some of the winners, but hopefully overweight the other winners. So it's just a broader way. Most of our clients, recognize that it's impossible to time particular themes year in and year out.
I think that's so important in the thematic world. I mean, for the best stock pickers, they can get it spectacularly right, spectacularly wrong in this space, because at some areas the valuations are so stretched. And anyway, but just to summarize then, Anthony, with regards to sectors in, say, iTech, which has the 8 tech megatrend themes within it. There's equally weighting of the themes, there's equally weighted at stock level, but it's this semi-annual rebalance that just brings the risk back into control, back into line every 6 months. So if, for example, last year when Tesla was up, I don't know, 900%, if over one 6-month period, it went from 1% to 3% in the portfolio, it would be then rebalanced back down to 1%, and the profits recycled and amortized across all of the other stocks on the rebalance. So that's how it works, and hence it just takes the anguish away from investors having to constantly rebalance within the themes. There's a question here which is actually relevant to that,
yes.
Anthony, and it's why do you have two robotics sectors on the slide? So I don't know whether you can put the slide back for the risk-adjusted return slide that you showed with the themes. But I know what the answer is essentially.
It's a good question. The answer is that robotics are often defined by different methods. You've got AI on the one hand. I'll see if I can get it up. But basically, you have AI, artificial intelligence, and there are one or two ETFs in that space. And then you also have separate ETFs that are just doing robotics or automation. So when we looked at the sub-themes and the comparisons, we actually had to look at the different ETFs that are available. And there are a couple that just do sort of AI and automation, and there are a couple that just do robotics. So I apologize if it looks like there are two, but it's basically covering the full spectrum of robotics. But there are slightly different definitions in our industry. But it's a fair question. Can I just touch on that? Go ahead.
The upshot there, Anthony, though, is from what you just said, and I believe is that those two robotic blocks in that table of risk-adjusted returns were two different products with differing performances. So even within in sort of that roughly similar aligned theme space,
yes,
you can get quite differing performances. So hence the equally weighted approach, multitude of stocks within each equally weighted theme, and the annual balance will just constantly bring that into line. So you're hopefully going to get a better, smooth, blended ride. Would that be fair to say?
Come back to our point. Actually, our robotics and automation sub-theme of the 8, we don't call it just robotics. We actually have robotics and automation. So we've actually covered the full gamut. I guess everything that we're doing tends to be a lot broader. A lot of our competitors may have 20 or 30 holdings in their underlying ETFs on the digital revolution or cloud. We typically have about double the number of holdings. Not in all cases, but I would say even our healthcare innovation, we have over 100 holdings. Is actually expected to go up to close to 140 holdings soon in healthcare innovation. Rob, perhaps I can just mention something that's on everybody's mind about some of these stocks that may be overvalued. And we do believe that the FANGs are very richly priced. And that's why we're quite careful about what's going on there with the antitrust rules, which I haven't touched on with Biden. Although hasn't put the kibosh on the antitrust legislation here, we expect it to roll on. If you look at what happened to Microsoft years ago, they got slapped on the knuckles and on the wrist here after about a 5-year process. We expect this antitrust legislation to sort of wind its way through very slowly against Google and Facebook, and it's basically being used as a stick to wrap them on the knuckles. We don't believe these big companies are going to be broken up, but they will be limited in any M&A or corporate activity. So actually the next tier down, let's call them beyond the mega caps, the larger cap holdings and the mid caps, they're going to have a lot more freedom to grow and make acquisitions. And that's where we actually see a lot more exciting opportunities, and where the valuations, frankly, are also somewhat cheaper. So we believe that we're quite comfortable where we are, not being overweight the 5-6 FANGs. Can I just touch on Tesla for a minute, because we have a bit of a controversial view on Tesla. We actually think long term it remains undervalued despite the 750%, 800% gains, which obviously has been dramatic. A lot of that is looking into Tesla more as a software company, and a company that could have robo-taxis competing with Uber and Lyft in a short order with their automated cars. So actually, Tesla really has surprised many by, many of us grew up in the 80s and 90s thinking that robots will look like humans. But the first real robot that many of us are interacting with are electric vehicles, because it's basically a robot on wheels. It's driven by software, and the likes of Volkswagen and others have really, really struggled to bring the software to bear. They've had some massive delays at VW, just as an example, at Volkswagen. There was a big expose recently just on their dramatic differences and the challenges really overhauling their car. But it's more of a software issue for them than anything else. And Tesla has its own proprietary software, whereas many of the other big names are actually outsourcing their software. So ultimately, we see Tesla disrupting not just the car maker themselves, but also in the energy space, selling their and licensing their battery power. And as you know, they've got two of the largest battery factories in the world today, here in the US, and another they've got in China as well. So we don't actually see Tesla as this bubble that's going to deflate over the long term. Look, there may be wobbles and there may be volatility in the short term, but ultimately there's a reason behind many smart analysts in the US continually buying into Tesla. They're looking at 10 to 15 years where EV vehicles in this country will be about 25 to 30% of the overall market. And they do see Tesla disrupting robotic taxis, basically. They think that Uber and Lyft are under threat, actually, by the likes of Tesla. If the automation and the self-driving capability really gets cracking and works well in the next few years. I know you have other questions, Rob. I'll turn it back to you.
Well, I think aligned to that, actually, there's a question on, basically hydrogen cars, fuel cell electric vehicles, battery electric vehicles, all I suppose, choices that, for the future. You mentioned Tesla. Have you got any views on any of those? Which would be the winning technologies?
Based on where the money's going and also the US being one of the leaders, the US is not really into building out hydrogen. They've really pushed solar here, and I think the Biden administration is very much in the solar camp on the one hand, and in the battery camp as well. So it looks as though Tesla has been on the mark here, and most of the big car makers. I mean, there talks of Volkswagen trying to roll out up to 60 different models, believe it or not, by 2030 in the electric vehicle space. Volvo is one of the leaders. They've gone increasingly the EV electric battery way. I know in Europe there's talk about the hydrogen cell as well. It just seems, from where I'm based, that at the moment the battery technology, lithium, but some other kinds of technology as well for batteries will dominate in the short to medium term. It's not to say something may change, but as long as the battery costs come down, the key thing really, Rob, you know this, is can the battery costs and the economies of scale down, and that's really what Tesla's been fighting and battling against. They seem to have won the battle recently. They've already created these massive factories. A place like Nevada has actually got the biggest factory in the world now, just producing batteries.
Sorry, and also, I suppose this plays into the distributed generation theme in due course for decarbonisation. The fact that there'll be sort of these mini grid, off-grid sort of opportunities where vehicles can plug back into the grid and put their energy back into that system in due course. Apparently, I mean, I'm sure people are working on this, and companies are being launched on the back of these technologies. So, and we'll have
one of the issues actually that's changed in the last year has been the sense, and it happened with NIO in China, where instead of going in and recharging your battery, like many of us thought, okay, you just go to a charging station, and they're actually wanting to replace your battery even quicker than it may take to fill your car with petrol or gas. So there've been there are ways that you could actually drive your car in and have a replacement battery literally just inserted in a matter of a minute or two, and faster than recharging the battery. So that's something else that's being discussed in terms of batteries.
Very good.
I know you want to get to one or two other points, Rob.
Yes. I mean, the question on sort of online gaming growth that you alluded to earlier with one of the slides that you showed. Obviously, massive business, compared to more traditional media and things in that space, but also huge, growth coming through, of course. What's the margin outlook, and what's the margin sort of position on these, the companies?
Yes, well, I think we have to be careful with digital entertainment, because obviously it's covering both the online gaming side, but also the massive streaming that we're seeing, which is really sidelining some of the traditional Hollywood players. So where I am here, you get the sense that some of the big traditional studios, I'm talking about Universal Studios and others, are having a very, very tough time. I mean, Netflix today is producing more movies than if you combine Universal, Sony Pictures, and some of these other traditional players. So what we've seen just very quickly is that the online streaming basically is sidelining some of the traditional Hollywood players. And obviously during COVID, interestingly enough, with the shutdown of movie theaters across the US, this trend's only being reinforced. So, of course, we all know about Netflix. There'll probably be ultimately in the US 4 to 5 key players. We have another big player here called Hulu. We have the HBO group, and one that I probably mentioned earlier was Disney Plus. Those 4 seem to really be dominating on the online streaming. But that's different to the gaming, which you touched on. Gaming actually has higher profit margins. And particularly if they roll it out through cloud and mobile, they're actually generating advertising revenue, the gaming companies. So actually their profit margins, by all estimations, is actually double what we see from the likes of Netflix and Disney, who still have to go through the old rigmarole of producing content. So producing content is not cheap. Actually, online gaming is a more profitable business, bottom line, than Hollywood. So if you're an old school Hollywood producer, you'd probably rather produce games that can go global in an instant and can actually have a longer term life cycle, because you can actually have a 3rd, 4th, 5th iteration of those games, unlike a blockbuster movie that sort of lives once and maybe you get a second one if you're lucky on the back of it. So to answer your question, watch out for online gaming, because their profit margins are significantly bigger than the traditional media that we see out here.
Thank you. And you know, with this week's earnings report, Anthony, can you just give us a little bit more sort of perspective there? We brushed out, you know, sort of looked at Tesla. Obviously, the stock price when I looked earlier on today was actually off, but then expectations always so high that I guess that's no surprise. But are there any others that you can mention from this week where, you know, the guidance has been particularly good? You know, in the tech space that we should be interested in as well, please.
All right. So although we had a wobble overnight, and I think we have to be realistic, the market's been going up like a rocket since the beginning of the year, and of course the day Biden was inaugurated, we had about a 2.5–3% gain in many of these tech stocks as well. It's not surprising that we've had a little bit of healthy retreat. If you just quickly look at the numbers, Apple actually had their best quarter in their history at 100. First time ever that they've exceeded 100 billion in revenues. They actually had 111 billion. Every one of their sales categories was double-digit returns or sales growth, particularly China. So China is really powering Apple. Their iPhone sales are largely were powered by continued Chinese sales. So we can see China's rebounding, which is good news for many of our tech firms. Microsoft is quickly really has been driven by 2 things, and a lot of it is the Xbox online gaming, which we talk about, which is they're basically the 2nd largest player right now in online gaming, Microsoft, as well as cloud. So I mean, Microsoft's market cap, Rob, was roughly a 1/3 of where they are today just 4 years ago, because they weren't big cloud players 4 years ago. It's become a massive boost. It's really more than doubled their market cap, just the cloud piece, and they had bang out earnings as well. No one expected them to have 50% sales growth in that cloud unit, Azure. And then just quickly, a few other ones. Regeneron had, which is one of our largest top 10 holdings in the healthcare space. Their antibody research shows that they can actually tackle those variants from the UK and South Africa and some other variants. So although they may not be getting all the news that Pfizer or Moderna is getting, we've been very, very fortunate to own Regeneron in our or healthcare innovation. We still expect very, very positive earnings also from some others later this week. But Tesla, although their profits may not have been as good as some expected, they hit their highest revenue numbers. I'll just say also they delivered more vehicles last year than they ever have. Now, granted, it wasn't 1 million; it was only 500,000 vehicles. But if they can step that up, and they claim they're going to be growing production by 50% year on year, and their target really is to hit 1 million vehicles by this time next year, to be on that trajectory. So, yeah, we don't want to be too positive, but I think the truth is that the big tech firms have actually had a very, very good last quarter. So in the face of a worldwide downturn, some of them have been fortunate, like Apple, to really have China rebound very strongly and boost their deliveries and earnings.
Yeah. So I mean, in terms of the regions you're most positive about, then, you know, the Asian rebound, obviously coming through thick and fast, you know, would be your, you know, would be a favorite.
Very much so. Yes, in fact, Asia has been the steepest and fastest adopters. We talked earlier about electric vehicles in China in particular, but across Asia, that's true. Cloud computing is growing faster in Asia than in the US, and the same is true for online gaming. The US is no longer the fastest growing place for digital entertainment or cloud. So the Internet of Things, which really defines the fourth industrial revolution, the smart homes, smart cars, we actually are most positive actually on the Asia Pacific region at the moment.
Excellent. Thanks. And also, we better answer these questions, Anthony. Slightly counter to your leanings, but is value investing dead?
Well, we're not actually going to say one way or the other. I don't think value investing is dead, but our indices are actually constructed in such a way that we'll own both growth and value. Ultimately, we're trying to have a representative mixture of the tech trends, and there are companies that haven't actually done as well. So you could argue that the small cap tech players, the mid cap tech players, just haven't seen that run up. And we believe that the FANGs being fully valued, and you have these antitrust rules, and you have Biden who's going to go after the Section 230 issue as well. I mentioned this a bit earlier. We see a lot more M&A activity emanating from the mids and small cap players. So I wouldn't say it's dead, no.
Good. And you sort of touched on another question that's up at the moment, saying, will the antitrust reduce growth and investor opportunity? And you're basically saying that, you know, anyway, net, you know, other businesses will, you know, the big ones will have to, you know, reshape, and then they'll go after the mid caps and the small. So it's just basically a knock on. The trends are in place, and, you know, if there's M&A activity, it just helps everybody, really, to be honest, doesn't it?
Very much so. I think you're going to see a lot more of the smaller guys, let's say below the top tier or mega caps, benefiting actually, because they're going to be able to make some very, very good acquisitions. There's a tremendous amount of M&A activity actually in the cloud space and also in the cybersecurity area. I'll just mention, Rob, many of us think cybersecurity is totally removed from cloud, but those are really almost like first cousins. Every time we've seen cloud usage spike, so is cybersecurity. So the whole work from home phenomenon has actually boosted cyber. In fact, last year, cyber was one of the top performing sub themes. And the reason is a lot of the cloud guys are buying into cybersecurity firms and want to offer sort of dual legs. And they're actually integrating a lot of encryption and cybersecurity into their platform. So cyber and cloud really are increasingly linked at the hip, I would say. And work from home has actually boosted cybersecurity in a significant manner, which many people didn't really foresee. So those companies are amongst the most exciting ones. There are firms such as CrowdStrike and others that we own that have actually outperformed a number of the cloud players, in fact.
Mm-hmm. Oh, thank you. And finally, there's a question here, and then we'll have to wrap up, Anthony. But if anyone wants to just levy another question or two in the interim, please do. But must draw to a close very soon. Do you think the trade war between the US and China will impact on tech in the rest of the world? Is a question here.
Yeah, well, I know I mentioned earlier on that we don't see the US changing their policy towards China really. So the Chinese internet, probably will remain splintered in that they, you know, obviously we know Google and others struggled to make much impact over there. But we know Tesla are in China, we know Apple are in China. So the fact that China is rebounding means that there are a lot of tech guys who are benefiting from China. NIO really is Tesla's biggest global competitor, you could argue, right now in the EV space. Tesla built this very, very large factory in Shanghai, so they are bullish there. They're actually exporting their vehicles from China, Tesla, but there's no reason why they couldn't sell there as well. So we're not negative on China per se. We still see China as being a dramatic leader, particularly in the electric vehicle space. Social media, we still own those companies such as the Baidus of the world, Alibaba, and our friends who are experts there believe that even Alipay, the one that had the IPO pulled, will still relist and go public in the not too distant future. So we still remain bullish over there. I would just say one thing, that Biden will likely use the international institutions a lot more. So any trade war with China that continues, it won't be at the rhetoric level that we saw with Trump, and he'll most likely do it with the likes of the EU and the UK and Australia, etc. It looks like they want to have a more coordinated trade policy globally with China rather than just going alone.
Well, that's very, very interesting. So thank you, Anthony. And I'm good. You know, we've answered the questions. So thank you very much, Anthony, for spending time with us and giving us some really interesting perspective. And let's hope the tech trends do continue apace and we get, you know, a fair wind for the themes again this year, because they were pretty startling for the last 2 years, pre-COVID and during last year's difficult year. So I think, you know, it's an exciting spaces still. And for those that, you know, joined us today, thank you very much indeed. And, you know, if you want to pick up there is some resource on the BrightTalk system, some fact sheets of Anthony's funds. And obviously don't hesitate to be in contact with myself or the team, or indeed Anthony in due course, if you need further information on any of these themes or solutions in the space with us. So anyway,
thank you,
Anthony,
Rob.
thank you, and I'm going to, you know, close down now. So thank you, everybody.
Thank you.
Cheers.
Bye-bye.